Okay, welcome everyone to tonight's presentation covering market volatility and its effect on retirement. My name is John Mantilla. I'm the Director of Finance here at Parco. My colleagues Quinn and Danny are also on the line tonight, helping with any question and answer sessions that we may have. So a little bit of background about our firm. We're a holistic retirement and financial planning company for federal employees. And we help people throughout any stage of their career. Maybe they're just starting out and just joined the federal government. Maybe they're nearing the end of their career and they want to make sure they've planned everything right for retirement. Maybe they're already retired and want to make sure that they've set everything else up for the next generation or anywhere in between. We work with people at every agency, helping them plan out their retirements to take advantage of the benefits that you have available to you as a federal employee. And we're getting noticed in more and more places. Places like the USA Today, Wall Street Journal, Forbes have featured articles from our team, talking about these different topics, trying to grow the word about how we think and how we think that federal employees in particular should be addressing retirement. So I do see a lot of familiar faces on tonight's webinar, so welcome back. And for those of you who are new, welcome. A couple ground rules before we get started. If you do have questions at all, ask them within the questions window within the Zoom call. As well, everybody on tonight's presentation will receive a survey asking for your feedback on the webinar. If there's things you think we did well, tell us. If there's things you think we could improve, tell us that as well. And then in addition, if there's topics that you'd like us to cover, tell us, and we'll make a presentation to go through that. The goal is that these presentations last about 20 to 30 minutes, and all of them are now available on our webinar portal. This one will be uploaded there soon as well. So we want to keep these as valuable as possible, but we also want to make sure that, it's digestible. So tonight we're going to be going through market volatility. As I'm sure many of you know, the year kind of went off to a crazy start with the markets. Stocks went down, the market went down. We had great returns in 2021, but that did not necessarily, or has not necessarily carried through into 2022. And there's a lot of things that people are concerned about right now. There's geopolitical risk with situation happening in Ukraine with Russia, things in China. There's obviously domestic risk. The Fed's planning to raise interest rates this year and inflation's high. So investors have become more cautious than they were last year. So tonight we'll be talking about the current market environment and also how to address and think about market environments in general when you're going through and navigating retirement or your career. Now, a couple disclaimers, because we are going to be talking about investments tonight. Always consult a tax professional when you're considering things like a Roth conversion and things like that. And then also, we're not making any claims or projections about market performance. I am an advisor. I am a Series 65 licensed financial advisor, but we're not making any predictions here tonight about what we think the market's going to do or what any investment's going to do. So we're going to start by first talking about what market volatility actually is. So really understanding that concept and digging into it. We'll talk about why volatility matters so much more in retirement than it does while you're working. And then we'll walk through the TSP's investment options and some key considerations to think about in the context of volatility. So let's go and start talking about what volatility is. So volatility, first of all, is a measure of the dispersion of returns for a given security or a market index over a given period of time. So something that's more volatile has a greater dispersion of returns. The returns jump around a lot. The value jumps around a lot. Something that's with a low volatility has a lower dispersion of returns. So it jumps around less. It's more stable. And these concepts are particularly important as you go through your career and in your retirement. So here, to illustrate this point, we show two return sets. The blue line, which is completely flat, has no volatility, right? It's a flat 6.25%. The red line is much more volatile. It jumps around. You can see, in year one, it's negative. In year two, it has a positive return. In year three, it has a downward or less positive return, it moves around a lot. Now, what's interesting is that the average return of these return sets is exactly the same. So even though the no volatility one is much more stable, right? The 6.25% number is flat in this example. It has the same return profile as the high volatility return set. So even though the returns jump around a lot, they converge to the same number because the average returns over that time period is the same. So in the first example, in the no volatility, we'd say the standard deviation of those returns is 0, whereas the standard deviation or the omega of those returns is much larger on the high volatility return set. You can see that with the difference as well. So the question is, why does the volatility of returns matter? If the market jumps around a lot, or an investment's value or an investment's price jumps around a lot, why does that matter? Well, it really starts to matter when you're thinking about what stage of investing you are in, or what stage of your life you're in. So there's 4 different stages of investing: accumulation, preservation, distribution, and conversion. During the accumulation stage, you're growing your wealth for the long run. You're in the middle of your career, maybe you just started your career, you're putting money away, saving for the future. You're not planning to touch this money for maybe decades down the line. So you really don't care how much the value of your account fluctuates, just so long as the long run return is moving in the right direction, is positive. Now, as you get closer to the end of your career, or you get closer to needing to achieve a goal, you move into the preservation stage. And that's where you might move your assets to a more conservative or less volatile allocation, because you want to make sure that money's around for your use when you distribute it, when you're in that distribution stage, when you're harvesting those assets for income in retirement, or making a major purchase, paying for your granddaughter to go to college, whatever your plans are for that distribution. And then we always talk about conversions as well. We're not going to go into it too deeply tonight, but it's the process of converting your assets from one tax status, normally a traditional tax status, like a traditional TSP, into a Roth or a Roth IRA, where it's no longer subject to any taxes after you've moved it into that account. So these are the main stages of investing. And it's that distribution stage in particular where market volatility really matters. So I know that this may be a familiar graph to some of you who've been on our webinars in the past, but here we're showing 3 sets of returns data from the year 2000 for the 20 years from the year 2000 to the year 2019 of the S&P 500. The first column shows the actual returns of the S&P during that time period. The second column shows those same returns, but sorted from best to worst. So the best returns happen at the beginning, the worst returns happen at the end. And the third column is just the opposite. Worst returns happen at the beginning, and the best returns happen at the end. So same exact data, just presented and or sorted in different ways. And so when you're accumulating your wealth, and you have a long investment time horizon, especially before you start to take that money, the volatility of those accounts, of how your money's invested, matters a lot less. Because if you have a long time horizon, you have more time to ride the volatility wave. You have more time to endure and to absorb market shocks. One of the most valuable things an investor, and I had this conversation with a client this morning, is that one of the most valuable things that you can have as an investor is time. So many people like to think short term and think, oh, well, this stock did really well today, or did really well last week, or last month, or did poorly last month or last week. Market fluctuations in the short term. I think it's Warren Buffett who says or it was Benjamin Graham who said in the short run, the market is a voting machine, but in the long run, the market is a weighing machine. So things over the long run actually aren't subject to the random thinkings of what the opinions of people in the market. The fundamental values tend to shine through. But because of the market fluctuations, that's what volatility is. So getting back to the example from before about the initial amount of $200,000 invested, if it had been in the S&P starting the year 2000, would have grown by the year 2019 to $648,000. That's what the market actually did, and assuming no withdrawals. Now we say, okay, well, what if we sort those returns from best to worst? And the best years happen first and the worst years happen in the end, but again, no withdrawals. The profile of those returns looks different, but the ending value is the same. This may not be intuitive right at first glance, but when you think about it, it makes sense because the average return of that return set has to be the same, regardless of how it's sorted, because it's the same data and you're not taking any money out. And so that's true if you sort the returns from best to worst or from worst to best. Now, the thing is, this all assumes that you're not taking any withdrawals. You're accumulating your wealth for the future. But that changes when your time horizon changes and you say, hey, look, I'm going to start using this money soon. I actively want to take withdrawals out to supplement my pension, to supplement my Social Security, to live on as income in retirement. When you start taking those withdrawals out, the volatility matters a heck of a lot more. So again, we start with that same $200,000 initial balance, but invested in the market, but now we're assuming a $6,000 annual withdrawal, so a 3% withdrawal rate. So that $200,000 is used to supplement an income stream in retirement. And because you're taking out that $6,000, the ending value is still positive and still bigger than it was before, but it's only $305,000. This is if you had been invested in the S&P 500. But now let's sort those returns from best to worst. So the best years happen first and the worst years happen at the end. Now we start to see a pretty big delta between what actually happened and what would have happened if the best returns happened first. The reason this happens is because you're taking out a flat, in this example, $6,000 in withdrawals. And since the best returns happen first, but you're taking out a flat $6,000, that $6,000 that you're taking out is a relatively small portion of your overall balance because you're experiencing significantly positive growth in the early years. This allows more dollars to compound, and that the result of that compounding over time results in this delta. Now, while we would love for those best returns to happen at the beginning and the worst returns to happen at the end, we can't predict that. And just as positive as that can be to have really strong gains early on, it can be just as negative to have bad returns early on, especially in a retirement, because you need that money to supplement the lifestyle you want to live. But if bad returns happen at the beginning, and this is sorted from worst to best, the account never recovers, such that even though there's very, very strong gains at the end, that regular $6,000 that you've taken out has basically taken out a much larger portion of your balance early on, reducing the ability of your account to grow compounded and recover, such that by the end of the time period here, the account's effectively entirely exhausted. So what's a federal employee to do, or federal retiree to do? Well, within the TSP itself, there's 5 core investment options. And one of the things that you have to consider is, what your goals are. Within any investment, we like to describe it as this triangle. There's trade-offs between liquidity, safety, and growth. So you could imagine assets that are very liquid and very safe, like a savings account, but they're not going to offer very much growth. I think my bank offers me about 25 basis points, or 0.25%, a quarter of a percent. So not getting much at the bank. There's assets that have investments that have great liquidity and great growth potential, like stocks or the stock market, but they're not safe. You can lose money. There's real volatility. And then there's assets that might be very safe and over the long run, they have strong growth potential, but they're not liquid. Things like real estate, for example, have strong long-term growth potential and tend to be relatively safe investments, but it's not very easy to trade houses. There's a lot of friction in that process. So the question is, what are your priorities and where do you want to fall given your goals? And so when it comes to the TSP, investing in the TSP, you have 5 core fund options, and then the life cycle funds. Now, the life cycle funds are comprised of a mix of the 5 core TSP fund options. So we're not going to go into too much detail about those tonight. We'll focus on the core TSP funds, which are the G fund, the F fund, the C fund, the S fund, and the I fund. So the standard deviations or the sigmas of the G and the F fund, the safest of the TSP funds, are pretty low. G fund is not very volatile, and the F fund, while more volatile than the G fund, is still relatively stable. Whereas the C fund, the S fund, and the I fund are far more volatile, meaning that their returns tend to fluctuate a whole lot more than the G fund and the F fund. That makes sense. G fund and the F fund are safer and more stable and have less potential for upside, whereas the equity funds, well, they have strong upside potential. They're not as safe, and they're not as safe. So we get this question all the time as helping people figure out their federal retirement process and investing side. What do these different funds mean? So the I fund stands for the International Stock Investment Fund, and it watches the performance of the MSCI EA FE index. So it tracks Europe, Australasia, and the Far East. And the I fund's performance has been very choppy, as you can see here. And actually for the year, because markets are down overall, the I fund's actually down almost 4% for the year for 2022. Next is the S funds. This is the small cap fund. So it invests in small cap and smaller companies, watches the performance of the Dow Jones completion total stock market index. So you're getting exposure with the S fund to smaller companies. And the idea is that these small companies could become big companies. Much more volatile. It's actually the most volatile of the TSP's funds. In fact, for the year, it's down over 10%. As strong as 2022 was, 2021 was, 22 is off to a rough start. And it's a similar story with the C fund. Now, the C fund stands for the Common Stock Investment Fund. It tracks the S&P 500, Standard & Poor's 500 large United States-based companies. So here you're getting large cap, generally exposure. When people talk about being invested in the market, this is generally what they're talking about. And again, more volatile. It's one of the oldest of the TSP's funds, or it is the oldest it's tied for the oldest. It was introduced when the TSP was introduced. So we have a long track record, and the S&P goes back much, much further than that into the early part of the 20th century. And for the year, it's down 5.18%. Again, much more volatile. Not as volatile as the S fund, but still exposing you to loss. I mean, for those of you that are in the C fund right now, I'm sure you've noticed that if you've looked at your account. Next is the F fund. This stands for the Fixed Income Index Investment Fund. It tracks the Bloomberg Barclays U.S. Aggregate Bond Index. So with the F fund, you're getting exposure to corporate bonds. So think the bonds of companies like Microsoft and Apple and Exxon, GE. So since you're invested in the bonds of those companies, bonds are a lot more stable. And I know we've covered this in past webinars, but the claim that you have within the capital structure as a bondholder is higher, but you only get paid interest. You don't get equity exposure. So it's certainly safer, but your upside's less. And the F fund's been challenged, even though it has been safe. And you can see that the axes here, the y-axis is a lot more scrunched than it was for the previous slides. So the standard deviation, the variation, the volatility of the returns is much lower overall. The F fund has had and can have negative years. Last year, the F fund lost money. Year to date, the F fund's down over 2%. So while, yes, the F fund is certainly safer than the C fund or the S fund and the I fund, meaning that you can't lose as much money, that doesn't mean that it's completely safe. And the F fund was the only one of the TSP funds last year that was negative last year. And next is the G fund. So the G fund stands for the Government Securities Investment Fund. It's the only TSP fund not exposed to market risk. So you could almost think of the G fund as like having money in a bank account in terms of the safety of it. The way the interest rate is paid, and we're actually going to be covering the G fund in more detail on our next webinar, but you get a mix of different treasury securities as the interest rate. So the thing is, interest rates over the past several decades have continued to go down. If you've noticed that your mortgage interest rate's a lot lower than it was maybe when you started your career, that's because interest rates overall have been going down because of Federal Reserve activity. Well, that's been great for people that are trying to borrow money for a mortgage. Investors in the G fund are faced with a challenge because the interest rates that are paid to G fund investors are tied to government interest rates. And since inception, we can see it's a very similar story. Again, the axis here has changed because the G funds never had a negative year, but that doesn't mean it's had many very positive years recently either. In 2021, if you had invested $1,000 in the G fund, you'd have $1,010.38 or $1,013.80, excuse me, at the end of the year. It only went up 1.38%. Year to date, the G fund's up 0.13%. That's the monthly interest rate that you've got. So again, very safe and very stable, but not paying a whole lot in interest, especially in our current inflationary environment. Especially after coronavirus, the government took a lot of measures to bolster the economy. And one of those things was basically printing a lot of money or putting a lot of money into the financial system. We're seeing the effects of this with the inflation rate. In December, inflation was 7%. On February 10th, the inflation rate for January will be published, and people are expecting that to be just as high as it was. So the challenge for federal retirees and people planning for federal retirement is, well, where do you put your money if you're trying to have it safe while also getting some return to offset this inflation when the G fund and the F fund maybe aren't doing that? And that's what our company and what our team specializes on, helping clients through every single day. Our systems and our whole company is focused on making sure that federal retirees plan well for retirement so they can enjoy the retirement that they've earned throughout the course of their career. Like I mentioned earlier on, our webinar portal is now live. So for those who would like to check out any of our past webinars, you can do so on our site. Here's a copy of tonight's Works Cited. And then in terms of upcoming webinars we're going to be covering, we're going to be talking next week about Social Security, questioning conventional wisdom. We'll be doing one on the G fund here relatively soon as well. We're going to talk about taxes and concepts that feds need to know. We'll cover TSP tips and tricks. So things like TSP loans, how the TSP match works and how to make sure you're taking full advantage of it, different rules that apply. And then one we're really excited to talk about in a few weeks is mortgage refinancing and some of the times to consider it, especially with rates going up, predicted to go up relatively soon, and the real costs of mortgages. And then we'll be doing, as always, our retirement paperwork workshop on the last Sunday of every month, which we're always really excited to help people with. It's one of my favorite parts about our business is helping people retire. So appreciate everybody being on tonight. It's wonderful to see you. Sorry about the technical issues earlier. If anybody has any questions, we'll all be here helping answer. If there's anything we can do to help make things better for you. And if you need to reach out to us privately or separately, you know how to reach us on our website, via email or phone. We're always here to serve. Wonderful to see you all, and we're looking forward to answering your questions.